Welcome everyone, and thank you for tuning in to hear my trading and market updates. This is Uncle Frank, and I'm not a financial advisor, nor is any of the content to be construed as financial advice. This channel is for entertainment purposes only. Please remember to hit the like button if you enjoyed the presentation, and be sure to subscribe to the channel so you're alerted when I have new information to share. So now let's get into the latest updates. Hey, welcome back everyone. I'm afraid I've got about 10 pages of bad news for the hedge funds in this episode, so kick back and enjoy because I'd rather be long than short in front of this court ruling no matter what the outcome. Headline: Tom Cruise breaks impressive Rotten Tomatoes record thanks to new Mission Impossible film. And from the article, the film franchise is about to release its 7th outing, with the second part due to arrive in 2024. Reviews for Dead Reckoning Part 1 have been glowing, with its score on Rotten Tomatoes currently sitting at 98% after 112 reviews. With the film, the Mission Impossible franchise has become one of the most acclaimed of all time. Moreover, at the time of this writing, the film has scored Cruise himself his highest Rotten Tomatoes score to date. The movies aren't dead. The theaters aren't dead. Get it through your head. Mission Impossible has an early access fan event tomorrow, and it's at 7 p.m., and the theater by my house is almost sold out. Looking good so far on that showing. And then the movie officially drops on Wednesday the 12th, and the same 7 p.m. showing at the theater near me is filling up nicely already. Now, 3 days ago, The Street published an article titled "Shorting AMC stock ahead of the ape conversion is a risky proposition." I would tend to agree because on Friday, the cost to borrow rate started at 257.37, but by the end of the day settled at 947.53. That's a clear sign from the prime brokers. They don't want to take any more risk with AMC. And just to recap, AMC closed at 420, down 2.10, while Ape gained 3.93% to finish at $1.85, bringing the consolidated price of AMC and Ape to only 6.05, down 0.33% on 27.4 million shares traded. Now, based on that last price of 420, be expecting support to the downside at levels 415 and 410. To the upside, expect resistance at points 430, 441, and 446. Now, I hate to be the one to point it out to the Hedgies, but our top line quarterly revenue may not be pre-pandemic, but if you examine that red line I added closely, it ain't that bad either. My original theory on this was the theater industry would continue to contract, but AMC would continue to expand and hopefully solidify its place as the world's largest exhibitor. I am also looking forward to the results from Q2. Now, we learned today that AMC remained on the New York Stock Exchange list of threshold securities, and it's been there since June 23rd. I don't know about you, but I would not want to be short a stock that's on the threshold list going into a court decision like this. It reminds me of back in March when Adam tweeted, "Many of you and we are aware that AMC Entertainment has been on the threshold list for 3+ weeks, indicating a number of FTDs. Some of you may be pleased to learn that we have contacted both FINRA and the New York Stock Exchange, asking that they both look closely at the trading of our stock. So don't worry, guys. If we remain on this list, Adam's going to call them again." And speaking of FTDs, I see some new spikes in town on the chart on the left. Back in May, the Street said new data shows that AMC's failure to deliver rates have peaked over the past 2 months, with this key indicator sitting at an all-time high. The sad thing about this is it's the SEC itself that prepares this data, and they know it's indicative of naked short selling, and I say they know exactly what's going on and allow it. I wish I could have listened in on those phone calls to the SEC and FINRA. And another indication that the AMC short trade is getting more difficult to manage is an increase in off-exchange volume. Friday's dark pool volume was 8.3 million shares, which was 54% of the day's total volume. And that brings the average over the past 30 days to 52.37%. It reminded me of an article in January of this year in Traders Magazine titled, "Off-Exchange Volume Spikes to Record Levels." Now, that same article featured some context on that record spike in AMC FTDs. April 2023 saw a 2-year peak in the number of failures to deliver for AMC. 87.5 million FTDs were recorded during the month. That's a significant jump over March, when the movie theater chain recorded 53.3 million FTDs. Would anyone like to explain to me exactly what this $100 million Goldman Sachs ass pump Gensler actually does at the SEC? Because I can't figure it out. Is he too busy covering his own ass from the fallout of the FTX debacle? Well, something tells me someday we will find out in front of an angry and confused oversight committee. And another thing Hedgies should be concerned about is AMC has moved into the 4th position over at Reddit over the past 24 hours on their sentiment and mention tracker with 99 mentions, and that's up 50%. And I also see XRP in the 6th position with 94 mentions, up 135%. Over at StockTwits, Mullen has moved into the 1st position on their most active list, and AMC has moved up to the 8th position. And over at Quiver Quantitative, the AMC hashtag has 551,000 Twitter followers, so it doesn't seem like investor engagement is going away. You may have divided us, but you're never going to break us. Now, I doubt the Hedgies are worried about this, but I am encouraged by it. We've had almost 9 months in a row of institutional selling, but finally in June, we had a significant uptick, and I added an arrow pointing it out on the chart. I would also remind you that on July 11th of 2022, our share price was $14.95. By July 7th, we ended at $4.20. This represents a decline of 71.91% over that period. And some of you may be wondering, what about institutional ownership of our precious ape? Well, according to this chart, I see a huge spike, but I'm attributing that to interest in the ARB play. As of Friday's close, Max Payne stands at 450. But what I'd be worried about if I were a POS predatory short hedge fund is the put-call ratio. Now, put-call ratio above 1 is typically extremely bullish. We finished Friday at 1.4085. Now let's do a little swan watching. This article appeared in the Motley Fool on Sunday. This bull market indicator has been right 82% of the time since 1950. This bull market indicator has only been wrong 4 times in 73 years. Now, what they're talking about is a tweet by Ryan Dietrich, who basically says if the S&P 500 is up greater than 10% during the first 6 months of the year, July and the next 6 and 12-month returns are much better than average. Also, the past 11 times this happened, the next 6 months were higher every single time. But before you increase your contributions to your 401k, maybe we should take a look at this black swan, Also from the Motley Fool on Sunday, money may be the thorn in Wall Street's side. What they're referring to is the US M2 money supply. From the article, between Carson Group's overwhelming bullish data set, strong US job growth, and corporate earnings handily surpassing expectations during the first quarter, it might seem like a no-brainer that stocks are pointing higher. But if you follow the money, literally, you'll find a different story. And folks, that is a nasty, nasty drop on that chart. He continues, last week, I laid out the potentially unnerving correlation between declines in US M2 money supply and deflationary recessions. M2 money supply includes everything in M1, coins, cash, demand deposits, as well as savings accounts, money market funds, and certificates of deposit below $100,000. In other words, it's available capital, but not money you have sitting in your pockets or in a checking account. Now, when back tested all the way to 1870, there have only been 5 instances where M2 money supply has declined by at least 2%, and 4 of them led to big downturns in the U.S. economy. 4 of these instances occurred a long time ago: the Depression of the 1870s, the Panic of 1893, the Depression of 1921, and the Great Depression. To be fair, the Fed Reserve now has more than a century of economic know-how to lean on when adjusting monetary policy, which means it's highly unlikely we'd see a depression in modern-day America. But no matter how you cut it, that drop right there is a very serious one. Now, I have discussed the commercial real estate black swan in multiple videos, but then this weekend, this article appeared. Goldman Sachs CEO sounds alarm bells for commercial real estate sector. Now, the chart on your screen depicts U.S. commercial banks' bank credit percentage off its highs. The thing about this indicator is once it begins its descent, it can drop violently and quickly, causing major disruption in the commercial real estate markets. From the article, rising interest rates and a shift toward remote work have participants cautious about the outlook in the commercial real estate industry in the coming quarters. Earlier this year, CBRE Group, the world's largest commercial real estate firm, pointed out several headwinds that could affect valuations of commercial real estate properties. Last month, Goldman Sachs CEO David Solomon acknowledged that his firm would have to mark down some of its real estate holdings in its second quarter earnings. Here's why commercial real estate valuations could be under pressure and how it may affect Goldman Sachs. In May, the Fed Reserve released its financial stability report. In that report, the Fed warned that trouble in the commercial real estate sector could pose a risk to the U.S. financial system. Stress in commercial real estate began during the pandemic, when employees shifted from working in the office to working from home. Many employees have returned to the office on a full-time or hybrid basis, but there remains less demand for commercial office properties than before the pandemic. Fueling the fire are rapidly rising interest rates and a pullback in bank lending. Since March of 2022, the Fed Reserve has raised its benchmark interest rate at its fastest pace since the 1980s, bringing its benchmark federal funds rate from near zero to 5.25%. According to data from MSCI, nearly $900 billion in U.S. commercial property loans will mature in the next 2 years. As these loans come due, borrowers will face a decision: refinance at a much higher borrowing cost or allow the leases to expire and walk away from their properties. Stay tuned. Hey, I want to thank you for watching, and please remember to hit the like button after this slide if you enjoyed the presentation. Subscribe to the channel and set the alert so you're notified when I have new information to share. See you at the bell.